This is the third in a series of videos describing how to work with the Excel financial projection template provided by Prosper Women Entrepreneurs Accelerator. A copy of the Excel file can be obtained from Prosper at prosperstl.com. This video addresses using the template for cash flow forecasting. Let's start by reminding ourselves that most measures of profit, for example, operating income, net income, EBIT, EBITDA, are not really cash flow, but an opinion. They approximate cash flow, but are not cash flow. When you run a startup, cash is scarce and needs to be a direct focus. Once you've completed the subject of our second video, sales or revenue forecasting, you've done the hardest part of financial projection because sales are the principal source of error in financial projections. The next part, cash flow forecasting, requires discipline, but generally speaking, the elements of cash flow are easier to understand and predict. The hard part is that it's easy to take your eye off cash flow by forgetting the distinction between cash and income. Losing focus on cash flow can be a very perilous proposition for any business. Income's not cash flow. It is the biggest part of cash flow usually, but there are a number of non-income cash flow items to consider. The principal items include working capital, which consists principally of accounts receivable, inventory, and accounts payable, all of which measure timing issues in collecting revenue, turning purchased items into saleable items, and paying suppliers. Tax is not usually a big cash issue for early stage startups because they typically run losses, but eventually when the losses turn into profits, the cash flow implications of when and how much cash tax is paid become important, especially if you're a C corporation, which most substantial investors require. Capital expenditures don't appear on an income statement at all because they buy assets that last for more than a year and they need to be included in any cash flow forecast. Fortunately, there are a few simple conventions for cash flow forecasting, and Prosper's template can help. A bonus is that the simple assumptions needed for cash flow estimation also make it easy to construct a full balance sheet and cash flow statement. Let's start with some of the basic elements of an income statement, which, as noted, usually makes up the biggest part of cash flow. Revenues are a pretty basic concept, and we're not going to discuss it here. Operating costs include three basic categories of costs required to serve customers, to find customers, and to administer the business. The first expense category within operating costs is cost of sales, which tallies all the costs of delivering the actual physical products or service to the customers, such as manufacturing costs, various logistics costs, cloud computing costs if your business is a SaaS business like the one in the upcoming example, and purchase product, for example, servers, if your business supplies these as turnkey package. The second category is marketing and sales expense, which includes the expenses of prospecting and closing potential customers. All the funnel costs included in this category, which also include any personnel costs involved in marketing, sales, and customer service. The third and final category of operating expenses is general and administrative expense, which includes development costs, which can be significant for a technology business and which is sometimes broken out separately from general and administrative expense. And all other operating costs like rent, insurance, administration, including the cost of your CEO and CFO, but probably not your chief marketing officer or your sales officer. Principal costs included in non-operating expenses are interest, which includes other financing charges such as fees and tax. Let's see how it all works in an Excel template. Starting with the Assumptions tab, note that the income statement assumptions are highlighted on the left in blue. We'll move down so we can see them better. This includes a hiring table, which we'll see in a minute, to input information about people employed in the business. A very short balance section is highlighted in yellow. Here's the hiring table. Here's the yellow balance sheet assumption section, and there's the green cash flow assumption section. We'll cover all this in this video. Let's begin with the cost of sales. The model makes basic provision for a variable component and a fixed component. For Corey's SaaS, the sample company in the model, variable cost of sales consists principally of the monthly cloud computing bill, which varies with the number of customers. Corey has figured out that each user, both revenue-paying customers and potential customers in trial, added to the platform costs for each customer added to the platform, costs about $20 a month. Since monthly revenue runs $65 to $85 per month, variable gross profits are about 70 to 75%. There's also a fixed support charge from an external supplier that is a flat $1,000 a month, and those elements are entered here. Sales and marketing costs, including personnel, excluding internal personnel, are detailed next, and you can see the costs per impression, click-throughs, and sales commissions are input here. Your sales and marketing cost structure will probably have some differences, and Excel functions can be used to model them. Other G&A expenses can be input below, including fixed expenses like rent, miscellaneous G&A, and a fixed charge for product development. In this case, a monthly cloud computing cost. There is a provision for non-uniform G&A expenses, which is this section here. And these are expenses that vary within the year. They might happen every 3 months. They might happen every once a year. And you can model those with this kind of logic. The input table here identifies the first month that the expense is charged and the number of months before it is repeated. There's also a block of preset payroll defaults that apply to salaries, and you should verify these presets are consistent with your own payroll charges. Included in the presets are 2 inflation rates, one for medical insurance and one for raises. A tax rate assumption is available. In this case, Corey estimates that federal, state, and local taxes will run about 40% combined. The template assumes a C corporation, as we mentioned earlier. The hiring chart is pretty self-evident. Each line describes an employee of the company. There are columns for each person requiring basic information like name, title, hire date, annualized salary, department, and a section for options and common, although those would be useful but not essential to making the model work. Note that you include the model uses some pretty nifty logic for aggregating this information into monthly salary estimates, and all that, including estimated future raises, is done for you as long as your people fit meaningfully into the categories provided. Note that you can include as many employees as you want by using Excel's abilities to insert additional rows above the bottom of the table. In this case, we've added 5 years worth of people. Notice most of them become to be determined people to get to the total that we think we'll hire. And here's how you enter. You just use Excel's capabilities to insert a row or additional rows as needed. Most founders have a pretty good idea of how many people they need for the next year or so, but to correctly use this model, you'll need to estimate how many people you'll hire over the next 5 years. You'll need to relate, for example, the number of salespeople you need to the number of new customers projected, and the number of customer service people you need to the number of customers renewing. This is actually fairly easy to do if you think through the algorithm carefully. That's all you need for the income statement projection. To complete the financial forecast, you need a small number of additional inputs. On the balance sheet, you'll need to input the cash balance at the start of the forecast period, the number of months on average that customers take to pay their bills, and a similar number of months for payables. Note that unless your customer is prepaid by credit card, receivables typically take anywhere from 1 to 3 months to collect, sometimes longer. Sometimes similarly, you'll probably take anywhere from 1 to 3 months to pay your supplier. In a product or a hardware model, you'll also need inventory, and the input would be the inventory turnover, or number of times inventory turns over on average compared to cost of sales. Because this hypothetical business offers software as a service, entering 0 in the cell sets inventory at 0. 2 more assumptions are needed to complete the cash flow statement: monthly cash expenditures, monthly capital expenditures, and months of depreciation for long-term assets. Once you've got that, the model will be able to generate a full income statement and cash flow statement, as well as a balance sheet for you on the monthly projection page. It looks like this, and it is, as you can see, is fairly simple when it gets to the balance sheet and the cash flow statement.